So if you weren't paying attention today, the Bank of Canada came out with an announcement, another jumbo rate cut, 50 basis points. Despite the uptick recently in inflation of 2%, we saw a really big move once again, by the Bank of Canada. Not a lot of people, or at least economists, were surprised by this move given the most recent job report. Now, this marks the Bank of Canada's fifth consecutive rate cut. And it seems like there's more in the hopper to help revive our sluggish GDP here in Canada and our declining labor market. So that is now putting a lot of pressure on our loonie, and I think we're going to continue to see that as we reach 2020 levels. And the real questions are, so what does this mean for the economy at large? And more importantly, at least to our viewership, the Toronto real estate market. My name is Ralph Fox, and I'm the broker of record and co-founder of Fox Marin. Welcome to the Toronto Real Estate Podcast. And today we have none other than friend of the pod, Jason Friesen, who's a managing partner at Outline Financial, here to break it all down for us. Jason, so glad to have you here.
Thanks for having me. It's nice to hop on the podcast again with great news. 2022 and 2023 seem to be the same story. Another rate hike. So now seeing 250 basis point rate cuts in a row and 5 rate cuts in total in a row, bringing the overnight rate down by 1.75 is obviously music to our ears, in the real estate industry, and then also just to, clients and consumers, clients that maybe have lines of credit and variable rate mortgages, definitely a positive impact.
Is it music to a jiu-jitsu practitioner's ears, though?
Absolutely.
Okay, good. Just wanted to make sure of that. I think the real issue, though, for me, from my lens, is while it is great news, no good news necessarily comes without some type of corresponding pain somewhere. And really what seems to be happening is that the economy seems to be in some type of free fall, and there's a lot of mixed messages. Now, of course, if you listen to Christina Freeland, our current deputy minister of finance, who by way of background was a former journalist, says that we are in a vibe session. So let's just sort of break that down versus what we're actually seeing on the street, in restaurants, in conversations with clients, and in our pocketbooks, and more importantly, on a lot of the data that's coming out there. And interestingly enough, there was a speech put out by Stephen Poloz, a former governor, Bank of Canada, who said that clearly we are in a recession, while Tiff, in his speech today, said that we are not expecting a recession. So, Jason, are we in a recession? Are we expecting a recession? Why are we making these big jump moves if the people in power and the people in charge are saying there's nothing to be worried about? What's your take on it?
I think they're also the same people that told us not to worry about it. Spend money, rates will remain cheap for an extended period of time, and then 2022 and 2023 happen. So
we're not thinking about raising interest rates until 2025.
Yeah.
So go out there and get a mortgage. Go out there and buy a boat.
To your point about the word on the street, I don't think you'd be hard pressed to talk to someone who feels richer today than they were, 3 or 4 years ago. I think that's just the reality of it. Everything costs more. There's a lot of financial stress. Interest rates are quite a bit higher than they have been over the last, last 10, 15 years, taking the last couple of years out of the equation. We're still sitting with fixed rates in the low 4s. We've got a prime rate, which has now dropped from its peak at 7.2 to 5.45. But you still have clients that are in variable rates in the mid 4s, which in the grand scheme of things, looking back over the last 30 years, doesn't sound terrible. But if you look back since, say, 2010, it's definitely on the high side. These cuts definitely do move in the right direction. I did some quick calculations. If someone has a $750,000 mortgage, where they were at, if say they were at prime less 0.8, which is a pretty standard variable rate, back in before June, the rate cut, their payments would have been $46.50 a month. Their same payments today based on these rate cuts are now down to $38.47. So it's a pretty significant drop. This definitely will move to help ease some of that financial burden. Where things go from here is really anyone's guess. To your point about mixed messaging, obviously seeing, jobs created but unemployment go up, it's like, when you look at when you look at the numbers, you have to dig in more than just looking at the headline. I think we're looking at, potentially seeing some further, I wouldn't say significant, but potentially significant reductions on the variable rate side. And at the same time, we've got upward pressure on fixed rates. So fixed rates, it's a common call that I get, every time we see a 50 basis point rate cut to the overnight rate, did my fixed rate go down by 50 basis points? The answer to that is simply no. Keep in mind, fixed rates, move in anticipation of what the central banks are doing, not just with the Bank of Canada, but the US. And we saw an inflation read from the US today, and seeing inflation, creep up, even though, we saw a 50 basis point rate cut to the overnight rate, yields, bond yields, which are what fixed rates are loosely tied to, and track US treasuries are actually up. So there's actually been a little bit of upward pressure over the course of the last, not just today, but even over the last month as, Trump talked tariffs and things like that. So, I think we're in a spot where we could potentially see fixed rates tick up, even though we're seeing the overnight rate go down. And obviously, we're starting to now get to that point where variable rates and fixed rates are almost on par. And 6 months ago, variable rates were 1.5% higher than where fixed rates are.
Well, I think there's a lot of smoke and mirrors going on when it comes to the economy. And I think that the people in power trying to stay in power and remain in control are giving, in my opinion, a very false narrative. I mean, yeah, we just saw a 50 basis point reduction, but the odds of that 2 or 3 weeks ago was, 10, 20%. We moved right up to 90% once this unemployment data came out. And if you break out the data, okay, great, we created 51,000 jobs, 45,000 were created by the government. That's not the sign of a strong or vibrant economy. Neither is it when you have 6.8% unemployment with 1.5 million Canadians currently out of work. And if you look at Toronto or the GTA, we're up to 10% of unemployment. So I think you have a lot of pressures on the economy right now that people just don't want to talk about. If you look at the labor force participation rate, we're at 64%. We haven't seen something that low. And so it's from 1997. If you look at wage growth, we went from 4.9 a year ago down to 3.9. So there's less people working. People are being paid a lot less. Insolvencies are going up through the roof, both individuals and corporations. We've seen productivity falling. We're down again. I think it's another 0.4%. We have the lowest productivity in the GDP in the G7 statement. I think in the summer came out by the Bank of Canada saying it's time to break glass, because it's such a dire situation comparative to every other country. Our GDP per capita has plummeted 8 quarters in a row. All this is just being paced over by immigration, and that's now being significantly brought down, which is the one thing that's been keeping us buoyed. So, I think our economy is a lot worse than a vibe session. And I think it's a disservice and a distraction to Canadians thinking that we're really stupid, and $250 at a cost of, I don't know, 5 or 6 billion to Canadian taxpayers is going to resolve anything, or even more importantly, get them reelected. And so I understand Tiff's position more, who's the current governor of the Bank of Canada. He has to present, a sense of calm. But I think there's a lot of layers to the economy that are really struggling. And I would think that the lower class and the lower middle class right now are the ones bearing the brunt of it. Those not holding assets, who don't own NVIDIA stock, who don't own gold, who don't own Bitcoin, who don't own their own houses, they're falling further and further behind. And so I see the economy very similar to what happened with COVID, where you have the rich getting richer and everybody else falling further and further behind, and nobody's even talking about it. And I think this is another move by the Bank of Canada to try and offset or address some of this. But I think these pressures are going to be going on for quite some time.
I agree. I think it's like, when I look at this as a mortgage broker, it's skewed on what I see day to day. Unfortunately, people on the lower end of the income spectrum are not purchasing houses. And so you have this, false, belief that everyone's doing well until you actually start to talk to people in the real world, right? I mean, if you're in a position and you're fortunate enough that you're able to purchase a home, well, obviously, the state of the economy is impacting you, it's not impacting you at the same proportionate rate as someone that's on the lower end that's, trying just to make ends meet, keep a roof over their head.
And where do you see this heading?
I don't know where we see a change in government next year, some sanity
Nice.
maybe being brought back into things.
That'd be a
Yeah.
really great place to start. I know there's
Yeah.
career risk in talking politics in public in an open forum, but there comes a point where if there's no more country, if there's no more wealth, I mean, the disparity between Canada and the US, if you look at gross GDP per capita or productivity, we're literally like falling off a table comparative to the US, which is moving up to the right. And I think this is only going to continue. And we clearly are not moving down the right path. So I think that definitely would be some help in the right direction for sure. And the thing for me that's so frustrating is this is such an incredible country. This is such an incredible city. There's so much unbridled raw potential here in Canada. And it's just a shame when you see the data and then you see what they're trying to spin off on us. It's frustrating and it's angering when you look at the bottom line numbers and you realize that if it's bad, it's bad, but let's just deal with it. And we're still not really addressing it. I think this move by the Bank of Canada is very, very helpful in trying to address it. But I think we're going to see continued rates coming down for the better part of next year. Like, where do you, if you were to guess, where do you think the bottom of the cycle would be?
So right now, the overnight rate is at 3.25. TIFF did say expect a more gradual decrease in interest rates. At the same time, both BMO and RBC came out today. BMO forecasted another 75 basis points in cuts by mid-2025. So that would bring prime, if we're at 5.45, that would bring prime down into the mid-4s. So pretty great. And RBC is saying we will see another 1.25% in reductions, which, if that's the case, would bring prime to 4.2%. So
where, in your opinion, where a year from now, we'll play this again.
Yeah.
Go out for dinner. Where do you think the bottom of this will end up?
I would probably say we see another 75 to 1% in cuts. The unknown wild card being south of the border. If we see tariffs, then I think we'll see more than 1.25% in further reductions. I think that's the unknown wild card here is, how, what we'll have to do. I was reading a report from an economist that said if the tariffs come into play, we could potentially see the Bank of Canada slash rates by 1% in an emergency session. So,
I honestly just amazed how one tweet and all of a sudden Justin Trudeau is down in Florida on his hands and knees. And all of a sudden now, I just read a report yesterday, Canada is going to spend $1 billion shoring up its border with the United States. I mean, if only that happens from the U.S. perspective, that was a pretty big win by just making that one idle threat.
Yeah.
$1 billion, and we're doing more of our share, protecting our borders. And some of the stats I've seen is more of the worrying illegal immigration or entry into the U.S. is happening from Canada, not even from Mexico. But for some reason, Mexico was the big talking point during the elections. So it's interesting to just watch. So I think it's more bluster because I think the impact will be significant on the U.S. economy as well.
Trump wants something, right? I think that's it. That's it. The impact.
But what I do think, last year, I'd say in the summer, when rates started to come down, I was thinking the end of the cycle would be 2.5%, and people thought that was aggressive, and I was kind of crazy for saying it. But I'm looking at things today, and I'm thinking that's not nearly aggressive enough. If 2.5% is considered the neutral rate, I think we're ending up sub 2. I think we're ending up 1.75. Somewhere in around that range, especially if things don't continue to get better or if the discrepancy between Canada and the U.S. continues. Yeah. Now, that will devastate our dollar. Go away now on vacation if you're watching this, because I think it's going to get more and more expensive to go anywhere. But where do you see that landing right now? It's impossible to know, and I'm sure both of our predictions will be wrong, but that's the way I see it.
The Bank of Canada put a report out in 2029 on the potential for the impact of the economy on if there are tariffs from the US. And they said off the bat, I was just reading that 25% reduction, the value of the Canadian dollar.
But it's interesting. I read this other report and it was talking about how when US GDP is above 2%, Canada has never had a recession, ever. So I do think that the US is set economically to really, really take off. I mean, the talk about vibes, the economic vibes in the US is extremely bullish right now. And in fact, continues and actually comes into fruition. They may help keep us buoyed, even though our dollar will continue to sink. So interesting time. So what are we talking? Fixed or variable today?
Not a one size fits all approach. You know, I think if you're willing to gamble a little bit, I would myself personally say that a variable rate at this point, as the gap narrows between variable and fixed, it starts to look more attractive, right? But for someone that's on a fixed budget, doesn't have a lot of disposable cash, they're really kind of, more focused on a fixed income. The fixed rate obviously affords you some guarantees that the variable rate doesn't. And so again, it's not a one size fits all approach, but for someone that's buying well within their comfort zone, not stretching themselves at all, and feeling like they do have a bit of wiggle room and the willingness to gamble a little bit. Now, the question I ask someone is, are you going to lose sleep if you take a variable rate? And if the answer is yes, take a fix. Don't think about it, take a fix. That's the consideration. But for someone that maybe has that ability to stretch themselves a little bit and go out on a limb, I think that variable rate will pay off. And at the very least, what it will do is it will at some point end up pushing interest rates on the fixed rate side hopefully down a little bit. We'll see what happens next year.
And how are you seeing your business flow? Because I always, just for the people watching this, Jason and his firm, they do a ton of business. And so you are one of my greatest short-term predictors of what's going to happen in the market. And so I'll call Jason and I'm like, how are pre-approvals? Like, how is your deal flow? What are you guys seeing right now? Because that'll give me a gauge as to what we could be looking at in the next 2 to 3 months. What are you seeing specifically with pre-approvals right now?
It definitely is a different vibe and a different energy. The last couple of years, 2022, 2023, and even in, kind of the first 6 months of 2024, clients would reach out, inquire about a pre-approval. We'd put some budgeting numbers together. They'd just unfortunately ghost. You'd never hear from them again, right? They, were spooked by the high interest rates and the carrying costs and things like that.
$7,000 a month
exactly.
for this $600,000 condo. I'm out here.
Exactly. And I'm finding borrowers that are reaching out now are looking at this as, okay, is this an opportunity before, we see the market pick up again? Keep in mind, there are some changes to CMHC that come into effect in, I guess less than a week, actually. On Monday, you can now buy up to 1.5 without 20% down. So we will be adding some more demand.
What's activity like on those type of approvals?
Lots more clients reaching out, quite a few more clients reaching out. I don't think a lot to go up to 1.5 without 20% down, but looking in that 1.1 range, right? People that were previously capped. But the mood and the sentiment has changed. Borrowers are now looking to get pre-approved. And when they get pre-approved, they're calling 2 days later, because pre-approval takes 2 to 3 business days, wanting to know where the pre-approval is because they want to make an offer on a place. So people are definitely moving forward with more confidence and more decisive about their decisions as well. I will say, and this makes me happy to say this, clients are being more realistic in keeping to their budget and not willing to extend themselves. Whereas the craziness of 2020 and 2021, you give someone a pre-approval and they'd call you back a month later and ask how they could get $100,000 more. I think that was unfortunately the craziness of it. And now people are definitely, the last couple of years have I think shown that people need to be a bit more cautious, which is great. The way that we always approach it is working backwards from a budget. So we always like to look at the numbers, not, in monthly payments and make sure it fits into your plan, not look at just how much you're pre-approved for. So I think we approach it a little differently than most, but definitely a renewed sense of optimism about, the housing market as a whole and lots of activity, lots of clients reaching out. November was very busy. December, January, February, all busy months. So it seems like we are in a situation where we are seeing, a bit of a rebound. And I think just if you're looking at, prices have started to rebound a little bit,
Yeah.
number of active listings are starting to shrink as well. Yeah, it seems like the market is shifting. I will say I'm not too sure about the rest of the Ontario market. This is, primarily we transact mostly in Toronto. I
Yes.
know in some other areas that doesn't seem to be the case, but it seems to be a different world and things seem like they're shifting, at least in the GTA and in Toronto specifically.
Yeah, I agree. We have typically we don't really go outside the
Yeah.
GTA or on the peripheries, and
Yeah.
we have a property on the market right now in Whitby, and much different vibe
Yeah.
out in
Totally.
Whitby than central and downtown Toronto. That's for sure. But usually these things start to turn around in Toronto, and then they hit
Yeah.
the outlying areas. So
Well,
really
if you see
interesting to
prices
see.
go up in Toronto, people will eventually be priced out of the
Yeah,
market. We talked about this also before about, the gap between condos and houses being pretty small right now. But as we see prices on houses start to increase, eventually people will be priced out of buying a house and start to look at condos, which will start to absorb some of the inventory in the condo market as well, right? So,
exactly.
yeah,
And it's interesting with this new initiative or policy, which is about to take effect next week, over a million, between a million and 1.5, with that lower amortization for first time buyers, that it's a small segment that can have the cash that can carry that, but because the payments are high, but doesn't have the deposit. But then again, like, if it adds 50 more motivated buyers to the market in downtown Toronto, that could
yeah,
literally suck up all the inventory between 1 and 3 million. Like, it doesn't take a
absolutely.
lot because there's not a lot of these type of houses coming to market. And so, I don't know, 50 buyers, 100 buyer
Yeah,
bump, and all of a sudden that takes a big jump. The next range goes up with it, and all of a sudden you've got a lot of pressure on affordability, like extreme pressure, and you'll have people looking back down, especially at lower rates at the condo market.
yeah.
So it will happen. There's a lot of inventory coming online to chew through, so it may not happen so quickly, but with completions starting to come down to nothing in 2028 and 2029, you can see a picture of where this is all going a few years down the road from now.
Yeah, I think I think we were talking about 2027 being a big potential turning point in the condo market, just with the small number of new properties actually hitting the market. I think what is it typically 20,000 new condos come online in Toronto a year?
Well, those are usually sales. There's
Yeah.
usually about 20,000 sales. I think it's closer to 30,000 that we
Okay.
have coming online. By 2030, it's slated to be zero.
Wow.
So that
What is
just
the
gives
what
you
is the what is the new construction market? Does it exist at all right now? Is
no,
it
no.
nothing?
It's 90% of the 10-year av, below the 10-year
Oh
av.
wow. Wow.
Because the problem is in typical markets, when there's not a lot of sales or there's pressure, prices can go down to reflect that. The problem or challenge if you're a developer that you have is because of all the inherent costs, the costs to build, everything else involved, developers central downtown Toronto can't go below $1,500 and pencil a pro
Right.
forma, $1,500 a square foot. So when you have resale at 1,000, that just doesn't make sense anymore. That gap is just too big. So for the
Wow.
time being, until there's a real recovery in the resale condo market, the
And that's a
that
lot
new
of
homes market,
room to make up. Like
it's a
five
lot of
hundred
room.
dollars a square foot
It's a
is
lot of
not.
room.
Yeah,
It's a lot
it's
of room.
not
But
even close, right?
once you get to 1,250, 1,300,
Yeah,
and you see a trend line, and you see lower interest rates, and you see certainty in the economy, and you see a competent leadership for government, it's a lot easier to make long-term decisions. But for the foreseeable future, new home sales are just going to continue to really, 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 really be struggling to levels we've never seen before in Toronto. And I think ultimately, if you're able to think long term, this too shall pass, and there will be great opportunity in the condo market in the coming year.
I think you just have to be prepared. There might be some short term bumps in the road, but long term
Of
game
course,
is the reality of it, right?
of course, of course. And I'm sure we'll get some nasty comments in the comment section saying that condos are going to go to zero, and all this other talk, or there's so much more to go, but it's just not going to happen. And it's amazing if you look at where prices of condos are today, resale versus in 2019, they're basically flat. And if you think about all the things the market has had thrown on it and all the inventory that's out there, people are holding on and they're not selling and they're not giving these properties away. And banks are working, as you know, they're working with their landlords. Something we talk about a lot on this show.
What's the rental market? What's the rental market doing for condos?
It's got some downward pressure. Probably, I think, down 8% year over year in terms of pricing. A lot of people are young people choosing to stay at home or hunker down. Youth unemployment, first entry jobs. I think that's the part of the market that's hurting right now, and we're seeing that reflected in the rental market. Never, ever, ever a dull moment.
Never.
Jason, going back to the Bank of Canada announcement, are there any sort of last thoughts you'd like to leave our viewership with? Anything, takeaways from watching the announcement today and what this means, or what advice you'd be giving clients when they call you up right after this?
Sure. As I mentioned, it's not a one-size-fits-all approach, but I do feel like this will push more clients into variable rates that are willing to, kind of take a bit of a gamble and understand the risk that comes along with it. At the very least, if you take the variable rate, it does give you the ability at any point in time to lock into a fixed rate. So you can, if you get nervous, convert to a fixed, although I never suggest someone tries to time the market. It's usually impossible to do. But I think, based on everything we're seeing and hearing, there are expected further cuts. How much more is anyone's guess? Again, maybe another 75 basis points in cuts, maybe another, to your point, another 1.5% in cuts, excuse me. So I think really the unknown is what happens south of the border. Obviously, the next couple of months will shine some light on that. But, I think if you're going to do a pre-approval, always hold a fixed rate. Just so you have something in your back pocket that locks you in for 4 months. That means your rate cannot go higher than that for the 4 months you're locked in. Typically, we do find lower rates, when someone actually has a property lined up, but it's always important to establish a worst case scenario, build your budget off of that worst case scenario. And then, once you have a property lined up, you can decide on what option makes the most sense.
Awesome. And there you have it from the man himself, Jason Friesen. Jason, thank you so much for joining us today. If you've made it to the end of our journey here, please be sure to hit that like or subscribe button. If you have any comments, especially if they're constructive, doesn't have to be positive. We do love differing viewpoints here. Please be sure to leave a comment down below. We'd absolutely love to hear from you. And thank you once again for joining the Toronto Real Estate Podcast. My name is Ralph Fox. I hope everyone has a great day.
Thanks for having me. Take care.